Welcome to Echo 315, Study Session 1, Nature and Roles of Business Finance. Introduction. Business finance is basically the methodology of allocating financial resources with a financial value in an optimal manner to maximize the wealth of a business enterprise. In this study session, we will examine the meaning, scope, and roles of business finance. Learning outcomes. When you have studied this session, you should be able to 1. Describe the nature of business finance. 2. Discuss the roles of finance managers. 3. Highlight the key finance functions. 4. Analyze the link between financial manager and financial market. And 5. Discuss stakeholders' objectives in an organization. Concept of finance. Finance studies address the ways in which individuals, businesses, and organizations raise, allocate, and use monetary resources over time, taking into account the risk entails in their project. The term finance may thus incorporate any of the following: the study of money and other assets, the management and control of those assets, profiling and managing project risk, and the science of managing money. Nature of finance and business. Business finance refers to money and credit employed in business. It involves procurement and utilization of funds so that business units could carry out their operations effectively and efficiently. The following characteristics of business finance will make its meaning clearer. 1. Business finance includes all types of funds used in business. 2. Business finance is needed in all types of organizations, large or small, manufacturing or trading. 3. The amount of business finance differs from one business firm to another, depending upon its nature and size. It also varies from time to time. 4. Business finance involves estimation of funds. It is concerned with raising funds from different sources as well as investment of funds for different purposes. Importance of finance in business. Business finance is required for the establishment of every business organization. With the growth in activities, financial needs also grow. Funds are required for the purchase of land and building, machinery, and other fixed assets. Besides this, you'll also need money to meet day-to-day expenses, e.g., purchase of raw materials, payment of wages and salaries, electricity bill, telephone bills. You are aware that production continues in anticipation of demand. Expenses continue to be incurred until the goods are sold and money is recovered. Money is required to bridge the time gap between the production and the sales. You also require funds to meet the ups and downs of business and unforeseen problems. Suppose as a manufacturer, you anticipate shortage of raw materials after a period. Obviously, you would like to stock raw materials, but you'll be able to do so only when money is available. In this era of competition, lots of money is required to be spent on activities for promoting sales like advertisement, personal selling, home delivery of goods, etc. In addition, funds are also required to avail of business opportunities. Suppose your company wants to submit a tender, but some minimum amount is required to be deposited along with the application. In the case of non-availability of funds, it will not be possible for your company to apply. Finally, all organizations need different types of finance, e.g., long-term, medium-term, and short-term. But the combination in which these are used differ from one organization to another. For example, steel industry requires more long-term finance to be invested in plants and machinery than in the manufacturing of leather goods or plastic buckets. Meaning of financial management. Financial management is the managerial planning and control of financial resources of a business to achieve the objectives of business. It covers all functions concerned in attempting to ensure the attainment of all financial objectives of the organization. As a subject of study, financial management is also referred to as corporate finance or business finance. Financial management is basically concerned with how corporate capital funds are raised and used to generate returns and pay returns to the provider of funds. The three major decisions in business finance are the investment decisions, the financial decisions, and the dividend decision. Corporate finance utilizes tools from almost all areas of finance. Some of the tools developed by and for corporations have broad application to entities other than corporations. For example, to partnership, sole proprietorship, not-for-profit organization, government, mutual funds, and personal wealth management. But in other cases, their application is very limited outside of the corporate finance arena. Because corporations deal in quantities of money much greater than individuals, the analyses have developed into a discipline of its own. It can be differentiated from personal finance and public finance. Roles of financial managers. The financial manager of a firm plays an important role in the company goals, policies, and financial success. Financial managers ultimately answer to shareholders who are the owners of the company. Shareholders are made better off by any decision which increases the value of their stake in the firm. The financial manager must be concerned, for example, whether the value of the firm would be increased more by an issue of shares to stockholders. The financial manager cannot avoid coping with time and uncertainty. Because of the importance of many financial issues, ultimate decisions often rest by law or by custom with the board of directors. For example, only the board has the legal power to declare a dividend or to sanction a public issue of securities. In summary, the responsibilities of financial managers include the following. 1. Financial analysis and planning, determining the proper amount of funds to be employed in the firm. 2. Investment decisions, the efficient allocations of funds to specific assets. 3. Financing and capital structure decisions, raising funds on as favorable terms as possible. 4. Management of financial resources, for example, management of working capital. And 5. Risk management. Roles of treasurers, financial controllers, and chief financial officers. In a large firm, the financial responsibilities highlighted above are carried out by the treasurer, controller, and chief financial officers. The responsibility of a treasurer include management of corporate assets and liabilities, banking relationship, cash management, credit management, dividend disbursement, insurance management, and pension management. The responsibilities of a controller include preparation of financial statement, internal auditing, custody of records, budget preparation, and tax administration. The responsibilities of a chief financial officer are to supervise all phases of financial activities and serve as a financial advisor to the board of directors. Finance functions. The key finance functions include investment, financing, dividend, and liquidity decisions. Investment decision. The investment decision, which is also referred to as capital budgeting decision, involves decisions of allocation of capital or commitment of funds to long-term assets that will yield benefits in the future. It involves the evaluation of the prospective profitability of the investment and the measurement of a cut-off rate against which the prospective return could be compared. Since future benefits cannot be predicted with certainty, investment proposals should be evaluated in terms of both expected returns and risk. The most commonly used cut-off rate is the required rate of return or the opportunity cost of capital. Financing decisions. A financial manager decides when, where, and how to acquire funds to meet the firm's investment needs. It determines the firm's capital structure. Optimum capital structure maximizes the shareholders' return with minimum risk. In practice, a firm considers many other factors such as control, flexibility, loan covenants, legal aspects, and so on in deciding its capital structure. Dividend decision. The financial manager must decide whether the firm should distribute all profits, retain them, or distribute a portion and retain the balance. The issues to be considered include dividend payout and dividend stability, stock dividend and cash dividend, the effects of dividend decision on the overall value of the firm, and achieving an optimum dividend level which maximizes the market value per share. Liquidity decision. The financial manager should ensure that the current assets are managed sufficiently, safeguard the firm against the dangers of illiquidity and insolvency. A proper trade-off must be achieved between profitability and liquidity. Financial manager and financial market. To carry on business, a corporate firm needs an almost endless variety of real assets, e.g., buildings, furniture, and equipment. To obtain the necessary money, the company sells pieces of paper called financial assets or securities. These pieces of paper have value because they are claims on the firm's real assets and the cash that they produce. Therefore, the company's real assets need to produce enough cash to satisfy these claims. As a financial manager, you stand between your firm's operation and the financial market, where investors hold the financial assets issued by a firm. The role of a financial manager is shown in the figure below. The flow starts when securities are issued to raise cash. 1. The cash is used to purchase the lease real assets used in the firm's operation. 2. Later, if the firm did well, the real assets generate cash inflows which more than repay the initial investment. 3. Finally, the cash is either reinvested, 4A, or returned to the investors who purchased the original securities issued by the firm. For example, if the firm borrows money from bank at stage 1, the firm repays the money plus interest at stage 4B. Thus, the choice between 4A and B is not completely free. Financial managers and goals of firms. We have said that financial manager of a firm plays an important role in the company's goals. The relevant question is, what are the typical goals of the firm that the financial managers help to achieve? Modern managerial finance theory is based on the assumption that the primary goals of the firm is to maximize the wealth of its shareholders. This translates into maximization of market value of the firm's share. Apart from the maximization of shareholders' wealth, other goals of the firm include the following: maximization of profit, maximization of managerial rewards, organization growth and diversification, and social responsibilities. Justification for profit maximization objective. Number 1. Profit maximization ensures economic natural selection, and in the end, only profit maximizers survive. 2. Human being performing any economic activity rationally aims at utility maximization. Utility can be measured in terms of profit. This profit maximization is justified on the ground of rationality. 3. Profit is a measure of efficiency. 4. Profit maximization is a consequence of perfect competition. 5. It is easy to calculate profit. 6. It is easy to determine the link between financial decisions and profits. Criticisms of profit maximization objective. 1. The modern market is characterized by imperfection, and thus profit maximization can no longer be a legitimate objective of a business. 2. In modern business environment, which is characterized by limited liability, a divorce between management and ownership, and multiplicity of stakeholders, profit maximization is regarded as unrealistic, difficult, inappropriate, and immoral. 3. It fails to provide an operationally feasible measure for ranking alternative courses of action in terms of their economic efficiency. 4. It ignores risk and uncertainty and ignores timing of return. 5. The premise meaning of profit maximization objective is unclear. The definition of the term profit is ambiguous. Is it short-term profit or long-term profit? Is it profit after tax or profit before tax? Is it total profit or profit per share? Advantages of shareholders' wealth maximization objective. 1. It emphasizes long-term. 2. It recognizes risk and uncertainty. 3. It recognizes the timing of return. 4. It considers returns to shareholders. Disadvantages of shareholders' wealth maximization objective. 1. It offers no clear relationship between financial decisions and share prices. 2. It can lead to management anxiety and frustration. maximizing and satisfying. Maximizing an objective means seeking the best possible outcome, while satisfying an objective means seeking only an adequate outcome. In practice, often the shareholders' wealth will be maximized subject to satisfying other objectives such as paying the workforce good wages, respecting health and safety issues, and minimizing environmental damages. Stakeholders' objective. The firm is a coalition of different groups, including the ordinary shareholders, the preference shareholders, the lenders, the employees, the customers, the government, and the suppliers. Each of the stakeholders must be paid a minimum return to encourage them to participate. This is the reason why in practice, management might seek to maximize the return to shareholders while satisfying the return to other stakeholders. The problems of multiple stakeholders is that each interest group is likely to have different objectives. For example, community may want low pollution, employee may want high wage and continuity of their employment, management want high wages and may want the company to be as large as possible so that they can empire build, and ordinary shareholders want high dividends and growth in the share price. Summary. In this study session, you learned that finance studies and it addresses the way in which individuals, businesses, and organizations raise, allocate, and use monetary resources over time, taking into account the risk entailed in their projects. Financial management is the managerial planning and control of financial resources of a business to achieve the objectives of business. Modern managerial finance theory is based on the assumption that the primary goal of the firm is to maximize the wealth of its shareholders. The functions of financial managers include investment decisions, financing decisions, dividend decisions, and liquidity decisions. This is the end of study session 1. Thanks for listening.